Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at multi-sensor AI.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
We're talking today about a company, multi-sensor AI, that's really sitting at a fascinating intersection. We're talking applied AI meeting physical infrastructure.
Yeah, and it really feels like they're at an inflection point. The data shows they're moving past just, proving the tech works
Right.
and into a full-blown commercial strategy. And this is all happening in the sensor fusion space, which is, incredibly demanding.
So for you listening, the goal today is to really cut through the noise. There's a lot of data.
A ton.
We need to connect the dots between their big Q3 operational wins, these aggressive new financial forecasts, and figure out why the analyst consensus has so quickly shifted to a strong buy.
Exactly. What's the real story there? Our mission is to unpack the evidence, look at the momentum, the expansion, the capital they've raised, and see how it all comes together.
So where do we start? I think it has to be with product adoption.
It has to be. But first, just for a baseline, let's quickly define what we mean by sensor fusion.
Good idea.
Simply put, you're taking data from lots of different sensors cameras, thermal, radar, you name it, and using AI to combine it all into one single, much more reliable picture of what's happening.
It eliminates the false positives you'd get from just one sensor.
Precisely. It's essential for things like autonomous cars or smart factories. You need that certainty.
And their Q3 numbers suggest that customers are getting that. The statistic that just, jumps out is a 167% year-over-year increase in active sensors on their platform.
That's just a massive number.
It's explosive. It's the clearest signal you could ask for that the product is being adopted right now in the field.
And that number, that 167%, that's the engine for this whole story. That operational success is what gave them the credibility to make their next big move.
The North American expansion.
Right. In October, they partnered with a huge global distributor to enter that market. This proves the platform isn't just a one-hit wonder, it's scalable across major markets.
Okay, but let's talk about that growth. 167%. That sounds like it could cause some serious growing pains. They just appointed a new CEO, Asim Akram. Doesn't that add some risk right in the middle of this expansion?
That's a great question, a crucial one. And the company frames it as a move for strategic focus. But I think what's really telling is what they did at the same time.
The cost cutting.
Exactly. In September, they ran some really targeted cost optimizations. They wanted to align their spending with their growth and just clean up the financial reporting for Q3. It shows they're not just chasing growth for growth's sake.
So disciplined growth, the new leadership is thinking about profitability from day one.
It suggests they are. Efficiency is just as important as expansion.
And that combination, fast growth plus financial discipline, is what brings in the money. Let's talk about the capital, because this is where the story gets really interesting.
Yeah, the investor confidence is palpable.
Right after Q3, they locked down $26 million in new capital. And that included a big $14 million private placement in October. That's pure fuel for the North American rollout.
And it's not just cash in the bank. It's a huge vote of confidence from institutional players. They're looking at this momentum, and analysts are, they're modeling a massive revenue turnaround.
What are the numbers looking like?
We're seeing average growth forecasts of around 70.4% over the next couple of years. Some are even projecting it could peak at like 114% in 2026.
Wow. And that's based on demand in which sectors?
Mostly defense and complex autonomous systems. Customers who absolutely cannot tolerate sensor errors.
What's interesting to me, though, is how they're funding this without loading up on debt. Their balance sheet is lean, but the thing that really stands out is their beta. It's a negative 0.29. A negative beta for a growth company. Can you break that down?
Yeah, that is a key anomaly. It's so unusual. Beta just measures how a stock moves compared to the whole market.
Right. Most growth stocks are way over 1.0, much more volatile.
Exactly. So a negative beta suggests the stock is, almost insulated from broad market swings. You might even move opposite to the market sometimes. For a company trying to deploy $26 million, that stability is a massive advantage. They're not getting knocked around by every bit of market news.
And does the trading volume back up that institutional interest?
It does. Daily volume is consistently over 200 million shares. This is not some illiquid stock. There's real depth here.
Okay, so the growth is there, the funding is there. What should we be watching for over the next, say, 3 months? What are the key catalysts?
Three big things to monitor. First, we need to see concrete proof that the North American deployment is accelerating. Are they hitting their targets?
Okay.
Second, and this could be huge, any updates on their data center pilots. Data centers are a massive high-margin vertical. A win there would be a game changer.
And finally, the reporting dates, I assume.
You got it. Watch the calendar. January 2026 for preliminary Q4 results, and then the full annual earnings release in February. Those reports need to show this momentum is continuing.
Okay, let's shift gears to the technicals. The chart seems to be confirming the story.
It really does.
The stock is trading well above both its 50-day and 200-day moving averages. I mean, that's a classic confirmation of a strong upward trend.
And what's fascinating is how that technical picture lines up perfectly with what the analysts are saying. The consensus is a hard, strong buy.
With some pretty aggressive price targets.
Very aggressive. The average 12-month target has been raised to between $2.75 and $3. Depending on the day, that's a potential upside of, well, anywhere from 105% to over 200%.
A 212% upside. It's a huge number. What's the justification for that? Is it just the growth, or do they have some kind of competitive moat?
It's the moat. The justification comes back to their proprietary algorithms. From what we're hearing, their tech does two things really well. It dramatically lowers false positives, and it processes the fused data faster than competitors. In defense or a factory, a false alarm costs serious money, or worse. So that reliability is their key differentiator.
That makes sense. Looking at the chart, in mid-November, the stock was in a range between roughly $1.26 and $1. What are the key levels to watch now for a breakout?
The short-term resistance seems to be between $87 and 96. If it can break above 96 with some real volume,
Then we could see another leg up.
potentially a quick one, yeah. That could be the trigger for a move toward the $1.20 to $1.50 range.
Of course, in a space like this, you always have rumors. What's the chatter on the street?
It's mostly focused on big partnerships. Think OEM integrations, maybe major defense contractors, things that would lock them into supply chains for years.
And those data center pilots you mentioned.
Yeah, the unconfirmed talk there is that they could be close to converting a pilot into a massive enterprise-wide deal. If that drops, it validates a whole new business line overnight.
Anything else?
The other bit of speculation is that with all this progress, they might be on the radar for inclusion in some growth-focused ETFs. That would trigger a wave of automatic buying from passive funds.
Now, we have to be clear. This is a high-reward story, but it is definitely not low risk.
Absolutely not. The volatility is real. We're talking average daily swings of almost 10%, with single days moving as much as 18%.
Yeah.
You need a strong stomach for this one.
And beyond just market volatility, what are the core company-specific risks here?
I'd say there are two big ones. First is just pure execution risk. The whole bull case depends on them delivering on that North American roadmap. Any slip-ups will get punished.
And a second.
Competition. The AI and sensor fusion space is red hot. You've got nimble startups and, huge tech giants all fighting for a piece of the pie. They have to stay ahead.
So if you put it all together, the growth, the money, the tech, and the risks, where do you land?
Overall, it still feels very bullish. I'd rate it solid 9 out of 10. You have proven operational growth, smart capital deployment, and a pipeline of real near-term catalysts.
Yeah.
And that proprietary algorithm gives them a tangible edge.
So what does this all mean for you, the investor? It seems like it's attractive for two different types of people.
I think so.
It works for short-term traders who want to play these upcoming catalysts, and it also works for long-term investors looking for a pure play on structural growth in defense, autonomous systems, and smart infrastructure.
Right. They've proven the product works and that people want it. They've secured the capital. But the narrative have to shift now. The key question for you to think about going forward is this. How quickly can management turn all that sensor growth and this new expansion into actual recurring revenue and, more importantly, margin expansion? That's what will justify these high-price targets. Making that leap from a great story to a truly profitable company, that's the final hurdle.